Nilesh, thank you so much for your time. It's just what a coincidence that Elecon engineering numbers came out just a while back, and and we are scheduled to speak today. This entire mid to small cap engineering value chain, very few understand this space, but it has done phenomenally well. Do you see some more juice left in this entire theme right now?
Ajay, first of all, thank you for having me on your show. I think I would like to correlate with something what happened in the chemical space over last 7 years. We have seen China plus one story, and we have also seen a lot of really a game changer which happened in the chemical space and the specialty chemical space. On a similar parallel, Ajay, if I look at engineering space, what is important is that most of these companies had good capacities on ground, and post 2009 crisis, they had a lot of disturbances in terms of balance sheet, the financials, and the demand. But post COVID, what we are seeing is that they have done a lot of road work and entering into the global market, which is resulting into a lot of orders, and really it is fruitful to the business the way it is unfolding. And simultaneously, these companies actually cleaned up their balance sheets extremely well. And finally, the master nail in the coffin is that we are the country which is English speaking. We follow American standards, we follow German standards, we follow European standards when it comes to designing of these equipment. And that is where I still see that this could be really a very long term story, which can continue to play for a really, really long term. And at the same time, our cost of manufacturing with at the same time along with the American standards or European standards, it's really much lower. And that is what we are seeing in most of these space in terms of you can name any number of companies and everybody is today exporting in a very large way. So yes, I agree. And I feel that yes, there's a lot of juice left in the sector. There could be ups and downs, but overall, as long as the Europe and American economy is stable, I think there's a lot of juice left.
Nilesh, let's talk about some spaces you are playing right now. Renewables is one space you are playing, and in the renewable space, we are seeing there are renewable related stocks which are doing solar and wind power. And then there are ancillaries who are providing support infrastructure, EPC companies in solar. Then there are crane companies and earth moving companies. How are you playing the renewables piece? And talk to us about that.
Ajay, it's a really interesting question. And if you really look at the macro in this particular space where we are very positive, is that if our country has to move from $3 trillion to $5 trillion, our overall electricity energy requirement is definitely going to go up. And the government estimate is we need about 550 gigawatt kind of electricity generation over next 7 to 8 years. So say by 2030-32. This is excluding your calculation based on electric vehicle, which is going to add further. Now, if you do the math, you almost 90% of that should come from renewable. That is what the government strategy is, because they're not letting more fossil fuel based energy generation coming up except what is in the pipeline. So if I do the math, it comes to about five. And on the PLF basis, Ajay, you also need to double the capacity. So for a 250 gigawatt of renewable, you will require to place about 500 gigawatt of energy generation in the country. Now, out of that, if I take 30% as wind, so that would come to 140, 150 gigawatt. Now, Ajay, even if you bring it down by 50%, you need to set up 75 gigawatt of wind generation in our country, and which means 7 gigawatt, 7 to 10 gigawatt a year. On top of that, we are seeing a lot of commercial and industries going for wind generation to also comply with their future requirement and ESG requirement. Now, in the past 5 years, if you compare, the country has put up only about less than 2 gigawatt per year, and now we are talking of 10, which is almost 5x. So the opportunity size is humongous. The capital flows are going to happen in this sector, and that is where we feel that there's a huge opportunity to play in the wind power, solar, manufacturing space, the EPC companies on the construction side, on the transmission side, and finally you will require about 5 to 10% of storage batteries because this is a very volatile power. So entire value chain, when you expect about 5 to 6 lakh crore of investment over the next 7 to 10 years, and this is such a concentrated investment, we are very positive on the space.
Nilesh, how are you looking at the storage companies? I mean, the market was quite unkind towards our traditional battery companies. There are only two large ones listed, that they have missed the EV battery opportunity. Then they got so oversold that they have come back in style, and they are also realizing they are upping their game in the battery storage side, in the EV side, all of that. Do you see value in our legacy battery companies, and do you think that they would come back for the EV opportunity also in the next coming years?
Yes, so Ajay, here there are two arguments. There are two arguments in the market. That one which says that the petrol and diesel based vehicle will be completely terminated to zero and everything will move towards EV. There is another argument that both will coexist. Now, in whichever way, when we look at it, at least we feel that for next 15 years, your lead acid battery, including the new requirement and the replacement, will continue. And finally, if we take it over to EV, you require lithium-ion batteries. Now, coincidentally, the space which you are referring, the two lead-acid battery manufacturers are really ahead of curve setting up the lithium-ion batteries. And that is where we feel that probably market had not looked at that. And finally, we felt that market was also not convinced or confident that whether they will be successful in lithium-ion batteries. There is also a challenge most of the time with market investors that whether the technology will change and how will they cope up with the technology. But in our view, the lithium-ion will definitely come up and lead acid will survive for next 15 years. And finally, Ajay, you really touched upon the storage world. So let me tell you that people have not understood the storage requirement. All renewable energy generation will definitely require about 10% of storage. And this storage is also happening from lithium-ion space because this is such a volatile power that you need to stabilize this power before sending it to grid. And that is where you require a good amount of storage. And that is additional opportunity for these companies.
Another piece of the value which is very important and again less understood, and that is transportation. One is generation of renewable, which is solar and wind, and the other is transporting it to areas where it is used. And that requires massive amount of very specialized towers and distribution infrastructure. Are there enough companies for that space? Can you name a few just for illustration purposes, and where our viewers can study?
Sure, Ajay. I think you have really put a real thoughtful question. When I said 5 to 6 lakh crore of investment, almost 3 lakh crore comes from the transmission side. Now, when you have a new form of energy, which is not a continuous supply, because solar and wind is not a continuous supply by nature, you need to improve your transmission grid substantially. On top of that, for 300 gigawatt of new energy generation, you require newer lines to come up. So all this calls for a massive investment happening in the space in terms of transmission lines, in terms of substations of various sizes, let's say 450 to 765 kVA substations. You will require transmission towers, you will require conductors to transmit this electricity. And that is where there are really good amount of opportunities, right in terms of EPC, right in terms of supply of materials. And yes, there are few companies available in the space. So those are not my recommendations, but there are companies like KEC, Kalpataru, Skipper who are into this space, which has been doing a reasonably good work. Simultaneously, Ajay, what is very important to note is that what we miss is the global broader picture. It is across the world, they are moving towards renewable simultaneously. And that is where huge opportunity unfolding in the transmission space globally. In fact, if you see the map which is showing that what kind of HVDC lines coming up globally, it is unbelievable. And country like India is also talking of something like 5 to 6 HVDC lines to transmit these renewable power, which itself is talking about 70,000 crore of investment. So yes, these are the companies which I feel they are available in the space, but one needs to do its own due diligence before investment.
Nilesh, one more question I want to understand from you is that you have also gone bullish on some of the paper companies. Again, this is seen more of as a commodity play. Some call it very cyclical. I see a name, a paper name in your portfolio. Why is that? And which part of that is it to do with school education, office, or the e-commerce cardboard packaging variety?
Ajay, unfortunately, the name is paper, but it is not a paper company.
My bad, my bad.
It is a packaging company for all these FMCG products, right from toothpaste to powder to even your, all kinds of FMCG products, food products, packaging company. We have got into this company purely our hypothesis was that when we entered it, it was available at half the sales, and the company was not delivering the right EBITDA what it was delivering pre-COVID level. So because of the volatility in crude oil prices and the raw material prices during the COVID phase, the company was not able to live up to the earlier margins. So we were confident that this company will come back to its earlier margins of pre-COVID level, which is about 11 to 12%. And the company was available at half the price. Plus, there was some land which company was about to sell off to create another cash. And this is a really strong, very sticky business. Though you don't get margin because you're supplying to all FMCG companies, the direct to consumer companies. But we felt that the valuation was very much favorable, and that was one of the reasons we invested into it.
Actually, yes, the earlier Avatar was a paper company, but eventually it evolved into a much more wider packaging company, like forward integration and all of that. But always great chatting with you, Nilesh. Thank you so much for dropping by on the show today.
Thank you so much, Ajay.